Good morning, all. Welcome to Dollars with Sense. I'm Terence Woude. I'm here with my co-host Ella Lang.
Hi, everyone.
We are your two financial gurus talking to you today about the Registered Disability Savings Plan, a fairly new program launched by the federal government in 2008 with the intention of encouraging people with disabilities and those who care for them to save and ensure the long-term financial security of their loved ones.
Yes, this is a phenomenal opportunity to seize if you haven't already done so, because you may not have known that an RDSP exists. So that's the objective of today's show, which is to inform you of the ins and outs of this plan, much like we did with the RESP episode. We'll discuss who is eligible to be a beneficiary and who can contribute to this plan. We'll talk about contribution limits and government grants and bonds associated with this plan. And we've got a case study for you as well to help illustrate how RDSPs provide a combination of government-assisted savings with tax-deferred investment growth, making it the right option for individual Canadians with disabilities and their families looking to save for the future.
It's going to be another episode packed with valuable information that you can listen to again on our podcast, available on our Dollars with Sense Facebook page or our YouTube channel. Type in Ella or Terence into the YouTube search bar and we will show up on your screen. Or if you prefer to read the transcript of today's show, that too will be available on the Facebook page. So settle in, turn up your volume. You're listening to Dollars with Sense.
Welcome back to Dollars with Sense. I'm Ella Lang here with Terence Woude, talking to you today about Registered Disability Savings Plans, RDSPs. It's a federal program that exists for 8 years now, and somehow only 78,000 of 500,000 eligible Canadians have opened an RDSP since the program's inception. Curious, especially since we know how difficult it is for the disabled to look for employment, and often they earn lower wages when they are working. So let's dive right in and learn all about this phenomenal plan.
So as we said, the RDSP is a savings plan designed to help disabled adults or the parents of disabled children to build up significant amounts of money for expenses later in life. A few years back, the director of the Planned Lifetime Advocacy Network, or PLAN, a Vancouver-based organization instrumental in the development of RDSPs, put it this way: think of it as a pension plan for those with disabilities so they have money for retirement. A key benefit of using an RDSP is it allows money to grow tax-sheltered, meaning the individual for whom the account is set up, the beneficiary, never pays tax on earnings until funds are withdrawn. Much like a registered education savings plan, or an RESP, money placed in an RDSP also benefits from grants matched by the government. But whereas RESPs can provide a sizable 20% return on contributions for up to $2,500 per year, RDSPs contributions can net a staggering 300% return depending on your income level. In some cases, the government will give you money even if you can't afford to make contributions. While there's no limit on how much you can put into an RDSP each year, there is a lifetime contribution limit of $200,000.
Wow, if properly managed by a diligent financial planner,
Like us.
that money can go a long way to help someone in their later years. But the biggest advantage of an RDSP by far are the Canada Disability Saving Bonds, so the CDSBs, and the Canada Disability Savings Grants, the CDSGs. There are contributions provided by the federal government that supply up to $4,500 a year in direct assistance annually, and up to $90,000 over a beneficiary's lifetime. But the amount of CDSG or CDSB a beneficiary can qualify for depends on family income, defined by the beneficiary's age. In other words, when a child reaches the age of maturity, majority, it's his or her own income that is applicable.
To be eligible to be the beneficiary of a registered disability savings plan, an individual must have a valid social insurance number, be a resident of Canada for tax purposes when the plan is first established, and at the time any contributions, grants, or bonds are received. Be eligible for the federal disability tax credit, be turning 59 or younger when the plan is first established and at the time of contributions are received, and finally be turning 49 or younger in the year in which the grant or bond request is made. This means it is a good idea to start the RDSP as soon as possible. This is important as well if the beneficiary is an adult at the time the RDSP is first established. Then the beneficiary must be the sole holder unless the beneficiary is not legally capable, in which case it must be one or more of the following: a guardian, tutor, curator, or other individual who is legally authorized to act on behalf of the beneficiary or the disabled person, or it can be a public department, agency, or institution that is again legally authorized to act on behalf of the beneficiary.
Just a quick note here that we're throwing you a lot of rules in this episode, but don't despair. Those are essentially details and paperwork that we can look after for you. It's part of a great financial planner's job to guide you through the existing parameters so that no pertinent information is left out. I mean, why would you do your own taxes when you can leave that to an accountant, right?
Well, I used to do my own taxes. I did my own taxes for years.
Yeah, well, I don't. I certainly know how it all works from the nature of my profession, but why leave it to chance? I'd rather let a professional submit my business expenses, for example, to the tax man, so there's nothing left out and I can get back to my own work.
Yes, you are right, Ella. Doing my own taxes was something I did when I was young and ignorant. And now that I'm old and wise, I know the benefits of using a professional when it comes to dealing with money. But let's get back to RDSPs. Let me show you some figures. When you are listening to the podcast, you will see the screen now on your chart, how this single 52-year-old mother of a disabled daughter can see her savings grow. Erica Chapman has a teenage daughter, Sarah, who is developmentally delayed and has autism, and she is worried about what will happen to Sarah after Erica's gone. Sarah will need around-the-clock care for the rest of her life, and it won't be cheap. According to Erica, there aren't a lot of daytime programs out there for the disabled. Even if you find one, you will be paying privately for it, and the going rate is around $80 per day. She wants Sarah to have the financial resources for a good quality of life. Unfortunately, a lot of kids like Sarah aren't getting quality support these days, she says. A lot of them are just watching TV, and that's not what I want for her. Let's say Erica's income is also in the lowest tax bracket, and private contributions of $1,500 are made each year for 20 years. Then, assuming there are no withdrawals in the period and the rate of return is 6%, which is about a moderate aggressive risk profile, the RDSP will be worth almost $234,000 at the end of 20 years. So, personal contributions of only $30,000 have grown to almost 8 times within 20 years. Pretty cool, eh?
You're so good at numbers, Terence.
Oh, why, thank you. I'm telling you, that's why I did my own taxes.
But now you're older and wiser, right?
Yes.
So as you can see, the majority of the growth comes from the money growing on a tax-deferred basis. This is the light green area on the top portion of the bars. The benefit is the growth from not only the personal contribution, but also from the CSDB, that's the bond, and the CDSG, the grant. Choosing between making lump sum contributions or annual contributions depends on your personal situation and needs. Now, let's take a break here. We'll be right back for more valuable insight into growing your wealth through RDSPs on Dollars with Sense.
Welcome back. We're your two financial gurus back for the second half of today's show on registered disability savings plans. More dollars for your disabled loved ones. So we've talked about who can be a beneficiary of this plan. For more rules and that we haven't mentioned for a lack of time, you can always go to the Canada Revenue Agency website on your screen right now, or call us at 778-879-0820. You can also write us at twofinancialgurus@gmail.com. That's the number 2financialgurus@gmail.com, and we'd be happy to guide you through it.
The next important element in getting the RDSP going is qualifying for the DTC, or Disability Tax Credit. Not an easy task from what I have learned. It requires filling in the T2201 Disability Tax Credit Certificate, a long, complicated medical form Canada Revenue Agency requires as proof of disability. Not only do you need the tax credit to obtain the RDSP, but the DTC reduces one's taxes in recognition of a disability. You claim the credit when you file your taxes. The DTC is non-refundable, which means you will pay less tax, but you do not get any money back. So if you were unaware of the DTC in previous years, you may be entitled to some money back. Sometimes this can be as much as $15,000. So now, although the application is lengthy and approval can take a few months, it's definitely worth the effort. So keep your hard-earned dollars instead of giving it to the government. And looking at your chart on your screen now, either you or your child may qualify depending on the type of disability that qualifies an individual for an RDSP.
For example, I have a client who has type 1 diabetes. That means she must measure the sugar in her blood 3 times a day and has to do so since diagnosed as a young child. She now is 32 years old, and quite a few years ago she registered herself with the government as a disabled person, and she was approved for the disability tax credit. Before engaging me as her financial planner, she had no idea about RDSPs, but because she already had the disability tax credit, it was an easy process to set her up. It was an easy process to set up her retirement plan, where for every dollar she contributes to the RDSP, the government contributes 3. And, much to both our surprise, she received retroactive payment from the bond and grants that are given by the government, totaling over $6,000.
Oh my gosh, that's wonderful. Let's look at who can open and contribute to an RDSP. Parents or guardians may open an RDSP for a minor. If the beneficiary is a minor at the time the RDSP is first established, then the holder must be one or more of a legal parent of the beneficiary, a guardian, tutor, curator, or other individual who is legally authorized to act on behalf of a beneficiary, or a public department, agency, or institution that is legally authorized, again, to act on behalf of the beneficiary. If an RDSP was established when the beneficiary was a minor, and the beneficiary later reaches the age of majority, then provided the beneficiary is not legally incapable, the beneficiary may have the right to become a holder, but if so, does not have to exercise this right. If the legal parents were the original holders, they may continue as holders along with the beneficiary. And if a guardian, tutor, curator, or public agency, department, or institution ceases to have authority over the beneficiary, because the beneficiary is now an adult or not legally incapable, that third party ceases to be a holder, and the beneficiary becomes the sole holder. Disabled adults without an impairment that prevents them from entering into a contract are responsible for opening their own RDSP. But for disabled adults unable to enter into a contract, a qualifying family member, including a spouse, common law partner, or parent, can become the plan holder who is in charge of setting up and managing the RDSP.
Once a disabled person has qualified for the DTC, an RDSP account can be opened up at any of Canada's major institutions. Watch out, though, as investment options are limited at most of these financial institutions, because RDSP plan holders can buy only the bank's in-house GICs and mortgage.
Are you okay?
It's that GIC, it catches me every time. As you folks may know, or as everybody may know, I'm not a big fan of the GICs, so that's why my reaction was like that. Here at Investors Group, though, our RDSP clients are invested into the same mutual funds that are open to all our clients. And again, much like RESPs, you can set up pre-authorized contributions either monthly, quarterly, annually, whatever suits one's individual situation and goals.
Another fantastic feature the government incorporated into the rules of contributing to RDSPs is by allowing the proceeds from certain registered savings plans to be transferred tax-free directly into an RDSP. So, these rollovers, as we call them in the industry, include RESPs, provided the plans share a common beneficiary, and RRSPs, RRIFs, those are RIFs, and certain lump sum amounts paid from registered pension plans. It's amazing. Provided the plan holders are the beneficiaries' deceased parents or grandparents. It's amazing. Of course, to take advantage of these rollover options, the beneficiary's RDSP must have available contribution room. But take note, none of the proceeds of these rollover plans are eligible for government grants, so CDSG, or bonds.
Contributions to an account can be made by third parties with the written consent of the holder, but once made, the funds are held for the irrevocable benefit of the disabled beneficiary and must ultimately be paid to the disabled beneficiary through DAPs, which we'll get into in a second. In other words, the third party cannot later take back the funds he or she had previously contributed. DAPs. What are DAPs? Now we're getting into the rules for taking the money out. Withdrawals from RDSPs are referred to as Disability Assistance Payments, or DAPs. DAPs are one-time withdrawals that can be paid any time after the RDSP is established. Each DAP will include a combination of your contributions, specified RDSP payments, government grants and bonds, and or the plan's income, or otherwise known as the growth of your investments. The portion of the DAP which relates to the government grants, bonds, income, specified RDSP payments is taxable to the beneficiary at their tax rate. The remaining portion of the DAP, i.e. the portion of the DAP that relates to the regular contributions you made or one made, that is non-taxable.
Now take note, everyone, the RDSP was set up with the intention of encouraging long-term savings. So it's important to note that if you take money out shortly after setting up your RDSP, any grant or bonds received within the last 10 years must be partially repaid. And that's $3 for every $1 withdrawn. In other words, if a beneficiary has only held funds for a few years and then tries to redeem, say, $1,000, he or she would have to pay the government back $3,000 worth of CDSBs and CDSGs. The exception to this rule is for RDSP beneficiaries with diminished life expectancy and is judged, of course, on a case-by-case scenario.
The other type of payments that can be paid to an RDSP beneficiary is through the Lifetime Disability Assistant Payment, or LDAPs. LDAPs are annual withdrawals that begin by the end of the year in which the beneficiary turns 60, then continue for the life of the beneficiary. There are maximum annual withdrawal limits if government contributions exceed private contributions, as well as minimum payouts based on a formula provided by CRA. Remember, regarding taxation, when you make a withdrawal from an RDSP, your private contributions are not subject to tax. However, both federal contributions, so the bonds and the grants, and income from the market growth within the RDSP will be taxed as income.
And also, again, because of the clawbacks associated with DAPs made prior to age 60, RDSP holders should remember that RDSPs are intended to help save for the long-term financial security of the disabled beneficiary. So ideally, if the beneficiary wants to be able to spend the government funds received in the plan, then the RDSP should not generally be used for short-term funds.
We're going to take another short break here, but we'll be right back to wrap up this episode around registered disability savings plans with your actionable items here on Dollars with Sense.
Welcome back. Before we end today's episode, here are a few more general issues around RDSPs we'd like to mention. Did you know an individual may be the beneficiary of both an RDSP and an RESP at the same time? That's pretty cool, as having or contributing to one does not preclude having or contributing to the other. So just because an individual is mentally or physically disabled does not mean that the individual will not pursue post-secondary education. The parents of a disabled child may be just as concerned about funding the child's future educational needs as they are about funding the child's long-term needs.
RESPs will, in some jurisdictions, be considered assets for the purpose of social assistance benefits, where RDSPs generally are not. Thus, if a disabled person is receiving social assistance, and assuming his or her province or territory exempts RDSPs from any income or asset tests, then given a choice between RDSPs and RESPs, the disabled person should choose RDSPs. If the disabled person is not receiving social assistance, or if the social assistance program exempts both RDSPs and RESPs, then the choice is not quite as clear. Contributing to an RDSP may still be valuable if the disabled person is eligible for CDSG or the government grant, or is turning 49 or younger, and is prepared to invest the grant-eligible assets on a long-term basis.
Ideally, the parents of a young disabled child will have sufficient cash to invest both in an RDSP and RESP for the child, so that the child can use the RESP to fund educational goals and the RDSP for longer-term objectives, including retirement. But if dollars are scarce, it may be a question of one versus the other instead of both. The parents should first assess the likelihood of the child pursuing post-secondary education. If it's a significantly unlikely case, then RESPs are probably not appropriate.
This is where Ella and I can help you. It would be our pleasure to meet with you and discuss if and how an RDSP is the right solution for you or your loved one who may qualify for the DTC. We can examine your individual financial situation and assess you and your family's needs and take the next steps together. Remember, you can call us at 778-879-0820 or email us at 2financialgurus@gmail.com. That's the number 2financialgurus@gmail.com. In the meantime, I encourage anyone who wants to learn more online to check out RDSP.com. It's a great resource in this subject. And of course, the Canada Revenue Agency's website has a section designated to RDSP with loads of the same information we have provided for you today. But remember, you don't have to do it alone. Your two financial gurus are here to help.
So your action item is simple. If you believe you or your child may qualify for the DTC to obtain an RDSP, or you have already qualified for the tax credit, take the next step and see a financial planner. And after looking at all the stuff we look at, your income, expenses, taxes, etc., we can work out a way to include a savings plan within your monthly cash flow and start growing and preserving your wealth in an RDSP.
Please feel free to send us any question or comments by email, again at twofinancialgurus@gmail.com, or call us at 778-879-0820. We have thrown a lot of information your way in this episode, and we have used a bazillion different acronyms today, so no doubt a transcript of today's show would be very helpful. This transcript is available on our Facebook page entitled Dollars with Sense, and you can watch or listen to our podcasts on the YouTube channel by entering our names, Ella and Terence, in the YouTube search bar. We are also interested in your feedback and questions, so don't hesitate to reach out to us to get the answers you are looking for. That's it for us today. Thank you to CKPM FM 98.7 for broadcasting our show bright and early every Sunday morning at 8 a.m. And thank you, listeners, for tuning in today. Ella and I hope you have a wonderful week, and may your dollars and cents be with you.